An influential market voice of the day. Anand Radhakrishnan, who is CIO at Franklin Templeton, joins in with his sense of the markets. Anand, it's great to have you on the show. Thanks very much for taking out the time to speak with us, to share your ideas and thoughts and insights on the markets. And it's just been such an interesting time in the markets. This summer, you've come out of the month of May with a fair amount of mayhem in mid caps and small caps. The large caps are holding steady, but they are also very closely linked to what's happening with global markets and global liquidity conditions, which are on the brink of seeing a strong withdrawal, at least the way interest rates are going. How do you sum up the market environment currently?
The domestic market in some sense is looking at a reasonably good earnings growth situation at this point of time, especially in the current year, as some of the sectors which were not contributing to growth has started providing that growth to the aggregate earnings. So while the global rates going up and that has kind of brought some uncertainty to the global equity asset class, from a domestic perspective, we are not that worried on the broader direction of the market and the kind of headwinds that exist globally. We don't think that similar kind of headwinds exist locally. So from a big picture perspective, we do see an year of reasonably strong earnings recovery across multiple segments within the market, and the markets remaining therefore well supported due to the earnings recovery. Wherever the earnings recovery is moderate or not that great, the asset value is supporting, or in other words, the alternate valuation metrics like price to book or replacement cost or in supportive, where the earnings growth is not that robust. So from aggregate perspective, it's both a combination of earnings support as well as asset value support exists for market.
But given all the funds that you manage and oversee, what is the strategy towards managing large caps from a risk reward perspective versus managing mid caps and small caps post the big sell off that we've seen year to date there?
The single biggest strategy which we are following at this point of time across cap is to remain truly diversified. This is slightly different from the general understanding of diversification, which is commonly understood as sectoral diversification. We think that at this point of time, market tends to be a little more skewed towards companies that are delivering near-term growth and are not favoring companies that are struggling on near-term earnings growth. And consequently, the valuations have become a bit more polarized. Even within sectors, we are seeing this polarization. For example, in automobiles, if a company which delivers good earnings growth in the near term is significantly better valued than a company which is not delivering near-term earnings. We do see that there is a need to remain diversified. That is, the portfolios need to have a reasonable amount of contrarian picks or companies that are having some challenges but are working hard towards overcoming these challenges. So the single biggest strategy therefore is to diversify well between growth ideas as well as a bit of contrarian value ideas. Whether it is large caps, mid caps or small caps, this particular strategy should be very handy for investors over the near term situation.
So Anand, when you say contrarian, where are the pockets that you're hunting right now? Because it's just a handful of 15-20 names which have done well on the Nifty, and we all know what's happened with the side markets.
So if you look at last 6 months to 1 year, if you, one of the biggest contrarian sector which have done very well is information technology. 1 year back, investors were not favoring this sector as much as they are favoring it now, and valuations were very reasonable. Even now, we do see the valuations to be fairly reasonable given the the growth coming back from a macro perspective. Market is extremely negative on healthcare companies, and many of these stocks are trading at multi-year low. And we do see that there is an opportunity to play contrarian here, because some of the regulatory headwinds that have impacted this sector is slowly waning as these companies introduce more molecules in the controlled markets, in the regulated markets. We do see the pressure on earnings to get lifted. There are of course some more headwinds in terms of competitive pressure. So one can have a moderate exposure or a bit of a contrarian exposure in that sector. Within sectors, again, within automobiles, there are reasons to play contrarian on specific ideas, companies that have had challenges on market share or profitability. Even in banks, one can have selective contrarian exposure. So there are opportunities to cherry pick values, especially from a bottom-up perspective. If you find enough evidence that these companies are making a lot of efforts to turn things around. Another example of a sector which is going through intense competition and therefore value destruction is telecom. On a 10-year basis, the mobile telecom revenues have not grown literally, despite the fact that the number of players have dramatically reduced due to intense pricing situation. Of course, this may not be for faint-hearted or for short-term players. One need to have a reasonably medium-term view on the understanding of the market and that industry to play this particular trend. So yes, to kind of summarize, there are multiple opportunities out there to play, and one can make meaningful returns over a period of time.
So let's pick up these themes one by one, Anand, and then let's start off with IT. You know, you rightly mentioned that the rally began there already 6 months back. But selectively, if I look at names, and I know you can't talk names, but I can surely take them. A TCS, for instance, that is already sitting at its life highs. There's a buyback perhaps in the works for which the board is already going to be meeting on Friday. Even the smaller ones like a Tata Elxsi, Hexaware, barring a few odd days of volatility, they're practically, you know, already making enough enormous gains in the last 2 to 3 months. Would you not say that maybe the best of the move in IT is already behind us, and for all those who are catching the bus now, it's a little too late?
Yes, I mean, the best returns are available when the valuations are lowest and the street is most bearish. Yes, you are right in that sense. Having said that, these are very good companies in terms of their financials, their cash generative abilities, the volatility of earnings, and their return of cash to the investors. Many of them are fairly robust in their capital allocation policies, and it is one thing to say that these stocks are trading at life highs. Another thing to say that are they trading at life high valuations? Which they are not. The valuations are still moderate if you leave out one or two or three companies. On an aggregate basis, there are enough moderately valued stocks in the sector. Yeah, you may not like one stock because of valuation, but there are something else which can be picked up. Plus they also have some positive tailwinds in terms of recovering global growth on IT spending, a favorable currency situation, and more importantly, the linkage between the headcounts to the revenues and productivity and profits will get slowly divergent in future years. So in some sense, you can say that there may be a little more that is left for investors to play in this sector. Even over the next 2-3 years. Some of the efforts the companies are making on the digital front in spearheading the efforts of the top global 500,000 companies is extremely interesting, and we strongly remain optimistic that these companies will play a meaningful role in the transformation of the global corporate IT space, and therefore will benefit from reasonably robust revenues and profit growth over the next 2-3 years.
Anand, just extending that discussion forward, what convinces you about the value in pharma and how are you evaluating it?
There are two ways you can look at pharma. One is that you value them based on their non-regulated market exposure. First, kind of look at their exposure to India, other emerging markets, and see whether the value is adequately captured by the market. Second is the kind of spending they are doing for regulated market and whether that is giving adequate returns to their spending. The spending is predominantly in the R&D part of these companies. Our understanding is the kind of money they are spending, the frontline pharma companies, bears no reflection on the value which the market is attributing to these companies for their efforts. In other words, the spending is far in excess of the value that is attributed by the market for these companies in their efforts for the regulated markets. So one of the two has to change. Either the market's attribution of the value which these companies can generate through their R&D will change, or the companies need to moderate their R&D. I think somewhere the reality will meet somewhere in between, and we think that is one key driver of value for these stocks. Second driver is the end market, where we have seen Indian companies, particularly because of FDA regulation, have not been able to introduce products with the pace with which they were introducing earlier. Some of this is changing as one by one these plans are getting clear. 6 months from now, maybe 12 months from now, we would see most of the plans, hopefully, kind of clear the regulatory hurdles in terms of FDA approval. That kind of removes the bottleneck in terms of introduction of more generic products into the market. These introductions should help them to ward off the price erosion that is happening in the older basket of products, and that kind of help them to protect their profitability. Third thing is the competitive intensity in the end market itself. We have seen a period of very intense generic competition and the consolidation of distribution. I think this is more or less played out. We might see that Indian companies slowly enter the specialty segment. If one or two successful products by each of these companies will change the perception, saying that these are pure commodity companies spending a lot of money for very little profits in regulated markets. I think this takes time, of course, for all these things to play out. It's not going to happen overnight. But I can see, I can visualize over a period of next 12 months to 24 months or even 36 months, one by one some of these things happen and improve the overall valuation of the sector as well as some of the top companies in the sector.
Curious to know whether PSU banks have made it to your contra list or not, because lots has happened in the last month or so. Just recently you had the latest RBI guidelines as well with creation of a bad bank. Seems like consolidation in the sector has been much in the pipeline, and more importantly the damage which has already taken place on these stock prices. There are mouth-watering valuations, no doubt, but is there enough meat on the table for you to go out there and start nibbling into PSBs perhaps?
More than value might be obvious to many in terms of price to book or things like that. We don't want to get swayed in by the optical value of the sector. Yes, the PSU banks offer an opportunity in the marketplace, but we need a decisive and a definitive way for blueprint for these companies, whether it is through consolidation, another round of recapitalization, right kind of management structures and incentives, reasonably robust regulatory framework, both some kind of a preemptive control as well as post control systems. We need many things to come together to generate structural value in that sector. There are one or two things which will come immediately probably, and that should probably give a pop or in valuations or values per se. But for us to become structurally bullish, we need multiple things to change in this sub-segment of banking, and I think that is still some time away. For example, consolidation has been talked about for many years now, and we haven't seen any meaningful consolidation, and the independence of the board we have been talked about for many years now. So while a lot of things is on the blueprint or on the drawing board, excepting recapitalization, we haven't seen anything dramatically change for better within that. Having said that, if one is a patient investor, one can visualize the way the regulations are going to change, and one can take a slightly more constructive approach in that space.
Anand, I can't but help notice your holdings in the Equity Prima Plus fund as well as the Focused Equity Fund, and I'm essentially talking about the financial holdings since we are on the subject of banks. So there's an SBI, HDFC Bank, but there's also fairly concentrated exposure to ICICI Bank and Axis Bank. Not talking specifics again, but how do you look at the kind of leadership transition as an investor that these banks are going through, and you know, what is your understanding, given that we are faced with the rising interest rate scenario, on how that may impact the recovery in the credit growth cycle for a lot of these banks which have, you know, which are servicing corporate clients?
Yes, as you might be aware, some of these banks have been impacted by their high exposure to stressed corporates in the past, and it is still playing out. This particular theme is still playing out, and it is not yet fully played out, but both these banks are making fairly reasonable provisions and efforts to kind of recover loan and participating in the processes like NCLT, etc., to recover that. Having said that, the key strengths of some of these slight corporate heavy but retail banks, their liability franchise is fantastic. They have good CASA ratios, they have great retail franchise on the liability side. Even on the asset side, they are making significant efforts to kind of move away from a corporate heavy to a more balanced portfolio. So so we are seeing some of these holdings, like whether it is Axis Bank or ICICI Bank, make that effort to diversify and de-risk them from lumpy corporate exposure. So from a forward-looking basis, they are in the right direction in terms of changing the book and reducing the concentration risks to one kind of assets, which should eventually kind of translate to less loan loss provisions, better return on assets, better return on equity, etc. But it is a slow grind, and it takes time for this to play out. But the platform or the platform of these banks are pretty strong. They have enormous market strength in terms of their ability to attract customers and sell products to them. So we have to value it adequately. I think at this point of time, market is overwhelmed by their corporate exposures as well as other issues which are kind of keeping their valuation under check. Regarding management transition in these banks, we do think that as banks evolve, the managements need to become more robust, the boards need to become more diversified, as well as play a more active role in running these banks. And these are truly investor-owned banks. In India, we have fortunate to have these kind of banks which are truly investor-owned, and therefore can be run on a medium to long-term basis without any agenda or overwhelming idea of supporting someone or other. So in some sense, they can take pure economic decisions and back it up. And I think if an improvement in management quality would help that bank to transition towards that, we definitely would welcome, and as a shareholder would support those initiatives of the board. And as long as it is smooth, non-disruptive, and maintains continuity along with change, we should welcome that.
It's been such a pleasure speaking with you this morning. Thanks very much for your insights and thoughts. Definitely would help viewers in understanding the market dynamics a bit better.
Thank you so much.